The start of the June quarter was dominated by tariff uncertainty as President Trump unveiled his quote unquote liberation day trade tariffs. And then a 90-day pause came days later, helping to de escalate trade tensions and stabilize markets. This, alongside moderating inflation in the US and Europe and clearer signs of monetary policy easing, catalyzed a broad based rebound in global equities in the June quarter. Small cap stocks benefited against this backdrop as they are typically more cyclical and rate sensitive. So global small caps finished the quarter as measured by the ACWI small cap index up about 6.85%, just ahead of large and mid cap that was up just a little over 6%. Emerging markets were a source of strength, up 11.3% in the benchmark versus developed markets up only 6%. Korea was the best performing country in the index for the quarter at plus 36% and also up year to date 39%, while on the other side, the US was a laggard this quarter, up just 2.9%. A pivot back into high growth and AI related industrial stocks helped propel growth over value during the June quarter as the ACWI small cap growth was up 9.68% versus value up only 4.12%. Within the market, from a factor perspective as well, beta and volatility were standout performers in the big rally in the June quarter. And momentum was positive, but it definitely trailed volatility and beta. So that was the summary of the market environment in the June quarter. From a fund performance perspective in the June quarter, the fund gained 9.47%, outperforming its benchmark by about 270 basis points. Within the strategy, Korea was a source of strength as we benefited from both positive stock selection and by being overweight. Most of the strength came within our portfolio in industrials, so stocks like Hyundai, Rotem, and Doosan were very strong. On top of that, stock selection in Taiwan was a source of strength, mostly technology companies like Elite Material. Germany was also strong for us, mostly in industrials and aerospace and defense like a Hensoldt. And Greece was a source of strength, especially from a stock selection perspective in the strategy. And most of that strength came in Greece banks. So Alpha Bank, Piraeus, National Bank of Greece, those were some of the best performers within the country. And just from a stock perspective, one of the big winners that we've seen over the last year, and definitely in the June quarter with the stock up 61%, just in the quarter alone, has been Pop Mart, the Hong Kong traded company where it's just benefiting from a massive surgence of Labubu and toys globally as they grow from outside of China and even in the US. So very strong growth from Pop Mart, and really what has been a really bigger theme in terms of kidults or adults being the ones that are the incremental buyers of toys. So that's been a very strong stock for us over the last year or so, and particularly in the June quarter. As far as the portfolio, how it's positioned and what's changed quarter over quarter, the weights within Korea and Taiwan have increased. Those have been the biggest changes in the portfolio. And also we found a couple more ideas in Spain than we see usually. On the other side, we're seeing a reduced exposure to China. We're still overweight, but we have reduced exposure in China. Again, we're coming to everything stock by stock, but that's what we see from quarter to quarter. And the other thing to note from a positioning perspective is the portfolio continues to be underweight the US, and that's been constant for the year. It's gone down a little bit more, but the shift away from the US has been something that's been kind of a theme for this year to date. We still find ideas, but it's probably our lowest weight we've had in our strategy going back to its inception. So we're just finding better ideas outside of the US at the moment. And then from a sector level, we've added weight in industrials, making it our largest overweight in the portfolio. That reflects many different things, aerospace and defense in Europe, but also the emergence of the industrial complex as it relates to AI has kind of taken new leadership after a stumble earlier in the year. So we're seeing much more an overweight in industrials in the portfolio, and at the same time, moving away a bit at the margin from financials and healthcare. The biggest underweight in the portfolio is the real estate, materials, and energy. But again, we come to these weights all from the bottom up based upon where we're finding the strongest trend. And that brings me to, from an outlook perspective, what do we expect? What do we see going forward? I think for global small caps as an asset class, I think a more favorable interest rate environment. We definitely have attractive relative valuations and maybe some early signs of a cyclical rebound emerging. And so those are reasons to be optimistic about global small as an asset class. For our fund in particular, we have the advantage of being adaptable and being able to pivot to what's working. And so as these periods of heightened volatility subside, and for sure we've had this year so far in 2025 has been very volatile and violent. But as this volatility subsides, new trends tend to emerge and momentum will adapt to reflect that fresh leadership. So what that leadership will look like as we go forward is anyone's guess. For us, it's not about prediction, it's about adaptability. Momentum doesn't resist the market, it flows with it. So we don't try to time exposures or time anything really. We just look at and find trends wherever they may emanate. So the adaptability is really the key to our outperformance over the long term. And I would just say from an investment standpoint with these crazy markets is don't try to time exposures, stay diversified, adaptable, and continue to invest in what works. And I think our fund is a good reflection of always being in the things that are working now.
This audio recording is produced by SG Hiscock & Company. It does not constitute financial advice and assumes a certain level of knowledge. It is general information only and does not take into account the investment objectives, financial situation, or needs of any person and should not be considered a recommendation. The views in this audio recording are those of the contributors at the time of publication, and neither SG Hiscock & Company, Melbourne Securities Corporation, nor any of its related parties provide any warranty of accuracy. Returns are not guaranteed, and before investing, please read the relevant product disclosure statement and target market determination available on our website.